we start the recording, but oh well. When you're looking at it again, you'll know what the problem was anyway. I did figure out the sound, by the way, and what we did last time was recorded, and the sound is actually the best that it's made out. You can actually hear it. I hate this. I listen to it here. Oh my God, that's important. But I was sure it would. Might be useful. Happy birthday.
You didn't give me a present.
So you didn't see tomorrow.
Here's a fair chunk. Oh, thanks. Not that I was calling.
Okay, so I'll start. Well, one thing you could do is you could figure out that you have negative cash flow of 300 in the first year. You could net each of these. That'd be all right. That's a way you could approach, right? Or you could treat this as an annuity, and you could treat this one as an annuity, two separate annuities. Either one's just fine. Do cash out separate from cash in if you want, or take the difference between them. I don't care, right? If you figured out the cash flow each year, you could discount each year back to them. That'd be fine. Or if it's the same cash flow each year like it is for each of these three, you could treat that as an annuity. And then discount it, figure out the value of it right at the beginning of the annuity, and then discount that back to them. So there's a variety of ways you could go. On the 200,000, it's 200 out now. What's the present value of 200 right now? 200. So that's out. And then coming back in, you get the 200 back. Should you have to discount that for the whole 5 years? It's your cash flow at the end of the year. What do you mean you don't know what to do? It's just figure out the cash flow each year. I gave you the discount already. I gave you the number of years. You got to know how to do this. You just did it yesterday. Calculating present values and future values and annuities. You don't even have to treat these as annuities. Don't want to. There's only 5. But if it was 20 years, sure we would. And I'll show you a little bit into that after calculus. So to show you that you might really want to have that wired. Give it a shot. It's a nice little problem. I'd say it's 5 minutes. What is that? Eat less and work less. If you work less, you have to eat less.
I'll have a sandwich.
Or you work more and you don't have time to eat.
I work 4 hours a week.
Just study more and you won't have to eat, is that it? Yeah, that'll work out well.
I'm not what I was saying. I didn't do that.
What did you want?
I have no idea. I mean,
I hate his questions.
what you said, good trouble doing it. Yeah, I got the percent that income is from. Great job.
Oh, that's good.
Yeah.
Just don't let it convince you you don't have 10 shots.
I thought it was like a fall, they had to do 21.
Oh, heck no.
I think they put that in
I think I
the
was
fall here, actually. I heard
Do you
the
want-
Constitution.
To do 21 shots in here.
Yeah, I'm not doing that.
Oh, yeah.
Yeah,
I'm not
that's
doing
ridiculous.
that.
Unless you started at like 8 a.m.
What's that?
and did it one.
Okay, I want to find out what I paid for this business.
present
But
value.
that's
which
an
is the
addition.
discounted
That's an
present
addition.
value of all of it.
Yeah.
Well, working capital, yeah, it's in addition to working
So
capital.
this is like the premium I'll pay for in addition to the 200.
Yeah.
Cause I got like a.
Find out what this deal is worth, and then you'll give me the 200, right? You put 200 in your business,
Yeah.
right, as part of it. But what is this investment worth? What's gonna be your contributing capital? Let's do it that way. Okay, plus it'll be the 200 you give up front, but you get that back, right?
Yeah.
You get your 200,000 back.
So this is, the deal is worth this much. If I treated this as an annuity, these two are discount expenses.
Yeah, that's all your cash out, that's it, the value of it.
Yeah, and then this is a working capital, this is a working capital back end.
Don't forget your revenue.
I've netted them already.
Oh, you did?
Yeah.
Okay, I got you, okay, yeah, could be.
I'm on the dog.
What'd you get?
57,400.
Is that all it's worth? You got 57,404, should I get something similar? Something different? I'm not saying it's right, I don't know. What'd you guys get? Okay. Working on it. What you did was you took the differences between them, and that's good, I like that. Okay. So what we could do is we could say our net cash flows per year. This is 200,000 now, right? Okay. This is the end of year one, -3, and that's negative, it's out, right? For the working capital. This is 300,000 coming back in at time one. Everybody agree? This is 50,000 out
Others still might be a little bit less this time than one.
at time two, right? And then this one is 200 in. Whoops. It's 200 in at time 3, 4, and 5. Everybody agree? That's 200 each time. But then there's also 200 more in from getting back our working capital, also at time 5. Everybody agree? And what I want is the present value of all those. So what's my net cash flow, just in total dollars? I think I'd have started with that, so to make sure I know where I'm at. What's my net cash flow on this investment? That one countered itself, right? The 200 working capital out, and the 200 working capital back in to me, right? So I had 350 negative, and then I had 600 positive, right? What's the difference between those two? 250. So my whole gain on this thing is only 250,000 in non-adjusted dollars, right? And then I'm going to get the present value of all of them. And what you could do then is you could take the present value of each thing if you wanted. That's one way, of each year. Okay? Or you could treat this one that's 1, 2, 3, 4 the same, right? Well, no, it would be 3 the same, wouldn't it? 1, 2, 3 the same. 1, 2, 3 the same. Oh, by the way, you could combine these two. Everybody agree? That's 400,000 coming into year 5, and I'd do that. So the first way you could approach it is you could say, this is worth how much? It's right now, so it's 200,000, right? So here's 200,000 out. Everybody agree? I'm getting the present values over here. Okay? This 300,000, I take it times what? 1 over what? 1 plus the interest rate. 1.15 raised to the what? 1. So divide 300,000 by 1.15. Everybody do it that way? So this is negative how much in terms of present value? What's good for that? Did you do it that way? So or you could look up the factor, right? 1 period, present value, 15% interest. What is that factor anyway? There's a present value table, 1 period. What is that?
0.86957.
0.86957. We're assuming all those dollars are at the end of the year, right? So that 300,000 doesn't go out to the end of the year, so those dollars are only worth 87 cents each right now, right? So what's 300 times 0.8695?
260,871.
260871?
Yeah.
Okay, so now I'm 200 plus 268.71 in the hole, right? Everybody got it? Okay. Year 2, I've got 50,000, and this is going to be times 1 over 1.15 squared, right? Raised to the second, 2 years. What's that factor?
0.75614.
So you can either use the tables or you can just calculate it, I don't care. So those are worth each of those $50,000 are worth 75 cents, right? 76 cents. Multiply 0.75614 times the 50,000 over here, and what do you get?
37,807.
That's all that one's really worth right now. Okay? You can see what's happening. If you get your positive cash flows in later years and your negative cash flows in earlier years, not so good, huh? But that's typical of a new business. It is. Okay? All right, and then what do we do? If you want, you could say I have a 3-year annuity of 200,000. I think that's how I'd do it. I have a 3-year annuity going down from here to here of 200,000. So I'm going to take 200,000 times the annuity factor. Present value of an ordinary annuity is the end of the period, right, guys? So this is going to be present value of an ordinary annuity for 3 years. Otherwise, I could do 3 multiplications, right? 1 for 3 years, 1 for 4, 1 for 5. That makes sense? Either way is fine. Because all that happens in the annuity table is they add the 3 factors together. Okay? Present value of an ordinary annuity. And it's going to be 3 years, right? N equals 3. Interest rate is still 15%. So if you go to that table, present value of an ordinary annuity, what do you get for that factor?
2.28323.
And that factor, $2.28, is 3 added up, right? It's the 3 years cash flows added up. Into your 3, 4, and 5. Okay? All right, so take that times your 200, and we find out what that whole 600,000 is worth, right? So 200 times 2.28323, and this is positive, isn't it? All those were positive. That's when we start making money. How much is that?
456,646.
All right, and then we have one more thing. Don't forget to do this, right? To get your 200,000 back. But that 200,000 has to be discounted at 15%. This is fairly high risk, right? But it's business, right? I'm investing in a business. So I want to earn pretty good if I'm investing in a business. I can make 12% in the stock market, doing nothing. I want to make more, so 15. Okay, and what's this going to be? To the 5th, right? What's that factor?
0.49718.
So those 200,000 are only worth about 100,000, aren't they? What is that number?
99,436.
So it costs me, just on my working capital sitting there, over $100,000 in this investment, right? It does. Because I could have done something else with 100,000, had it grow, right? That makes sense? Okay, so what do I think the deal's worth? What is that 250,000 positive cash flow really worth in today's dollars, discounted at 15%? Negative 200, negative 268.71, negative 37,807, positive 456, and positive 99. What do you get?
57,404.
Did you do this? What's that?
I was just gonna say, number on the right is what you would want to pay for it.
That's how much I would pay for that business. That's all I pay. And it looks like, it's pretty good, right? 250,000 in 5 years. Yeah, that's not that'd be a bad investment. Well, it's not. Pay 57,000 for it. You make 15% interest.
So that's just,
Your money.
that's your return in addition to the net capital that you have to promote?
No, if you invest nothing, that would be your return in investment in return in addition. This is how much I'm going to pay. I will pay 57,404 to buy the business if I'm buying it from somebody.
Okay.
That's how much I think it's worth. If I have to invest nothing, this would be in addition to 15% return.
So up front, you're actually paying $257,404.
$404. Yeah, and then you get back 200 again. You got it. But you get all those cash flows back. Yeah.
You just take the net of each year and then discount
Yeah.
program.
Mm-hmm. Or if you wanted, let's calculate it another way. That's exactly right. I did the net for each year. What you could do is you could do all the revenues as positive, right? Discount that one for 2 years. This is an annuity for 3 years, right? discount that and add those together, and then the 200 that I get back at the end, right? So I can do those, all the cash in. And then I can do all the cash out. That's pretty easy. It's 300 each time, right? So I've got a 1, 2, 3, 4, 5-year annuity. I discount that annuity for 5 years, and that's the negative cash flows. But plus remember to have the 200 negative. And you know what? When you do that, you will get 57,404. It'll be the same number. It doesn't matter how you group the cash flows. So I would group them however I could to get the fewest multiplications.
I like the math way better.
Well, you can see it better.
Yeah.
Okay. Now you might be tempted here to, instead of treating that as a 3-year annuity, do each one, and that's just fine, except let me change it to this. Okay, everybody done with this? You can calculate this now? Yes. That's to leave me alone. Okay, anyway, either way. This is now going to be, I want to know what the business is worth if I think years 3 through 10 are this much. Whoops. We got rid of one more, sorry. Okay, so I've got that much going out at the beginning, right, guys? And then I think years 3 through 10 are going to be, this is going to bump up to 380,000. And this is going to be 300,000. Now, how do you think you'd approach calculating? Bet you'd do it differently. Go ahead and calculate that one. What's that thing worth?
For some reason, whenever I was doing, you know, I used like the 600,000 together to do the annuity. When I did it separate, it didn't equal out. You know,
It's 200 each time.
Yeah.
Right.
and then we use, if you just did it separately, 1 over 1.15, third, fourth, and fifth.
Yeah.
Those don't, it doesn't equal the same.
Yeah, that's,
It's off by like 100,000.
yeah.
That's what I don't
We wrong. We
understand.
did something wrong then.
We're talking like 355 or
345,000.
Oh, you know what we did?
Yes, I got 345 today.
Well, you got 345 instead of,
289 is what you're saying?
Yeah.
Yeah.
you got 289 instead of 345?
No, it's.
No, we got
oh,
345, 289.
And
So
you,
345,000.
and if we did it with the ordinary annuity, then it would be 450, we had 456,000.
Oh, you know what we did wrong? We didn't discount it from there back to now. We discounted to 3 years from now, didn't we? Or 2 years from now. We treated it as a 3-year annuity, right?
Yeah.
Which brought it back to the beginning of the 3 years. Now you gotta discount that for 2 years. So we did it wrong.
Discount that for 2 years.
Take that, the annuity, where'd it go? Take the annuity and then discount that for 2 years at the present value, see if you get the same.
What number are
Oh,
you
wow. Yeah, I'm sorry. I screwed up. Yeah. This number right here,
What do you guys get?
this
345, 289.
Yeah.
This, we just calculated the present value at the beginning of the 3rd year here, right? Because it's years 3, 4, and 5. So it's the beginning of the 3rd year. So I have to take this one times 1 over 1.15. Thank you so much. Raised to the second. So that's going to make this a lot less, right?
Yeah, because I was wondering
What is it
how
make
we
if
did
you do that? Yeah, now it's a negative deal. This is a bad deal, okay? So how much did that number come up to if you take 456, 646 times 1 over 1.15 squared?
It's 345, 288.
Thank you so much. I really almost screwed you guys up big time. Okay?
So from that annuity, you do the present value of the sum for that?
Yeah, because you found out the value of the annuity at the beginning of the annuity, didn't you? So we're finding out its value at the beginning of that 3rd year. So when you get that, you have to discount it then for back to now. You had to discount it for 2 years? Okay, yeah.
So
So that would have been 345, 288, and now what's your total? That was really good, way to go. Because you got that Java curl all this time, everything's clicking. Yeah, so negative 200 plus negative 268.71 plus negative 37.807, then plus positive 345, 288 plus positive 99,436, what do we get? Negative. Now that doesn't mean we don't make any money. Obviously we'd make 250,000, right? But we don't make 15%. We're short of 15% by that much. Okay? So 15% is your cost of capital you expect to earn. This is not a good deal. That makes sense? Try the other one here. It'll sort of make the point even better. Try this one that I just did. Go ahead and work that. I'm putting out 200,000 to get it back at the end. And usually when they give you working capital, they won't tell you to get it back at the end. You think you get working capital back at the end? The cash in the bank, you think is there? You get it back at the end? Sure. Okay. Otherwise, you lost it. You net loss. There's something you're accounting for the net loss out there. And net profit. Good, folks. They got a number. So we'll do a 3 to 10 is what, 8-year annuity? Yeah. Into year 3, into year. That's the other thing. You gotta be really careful counting years. It's not a 7-year annuity, it's an 8-year annuity, isn't it?
So you
Into year 3 to the end of year 10.
So you do a $1,000 annuity and then discount back to the.
Yeah, you're gonna have to discount it for 2 years. Yeah, because when you discount it, if it's a 7-year annuity starting at the end of year 3, when you discount it, you'll discount it to the beginning of year 3, which is the end of year 2. That's the other thing that drives you nuts with this stuff. Where am I? Right? And that's hard. So where did I value it to? So when you do that 8-year annuity, year 3 through 10, you will value it to the beginning of year 3, which is the end of year 2, when you take the present value of that. And then you need to discount it 2 years back to now. Right? And then we got the 200 going out right now, and then we're going to have 200 coming back in, and the 200 comes back in 50 years down. Okay, so you discount that for 10 years. So I'll have 2 multiplications to do, I guess. 3. 1, 2, 3, 4. 4 multiplications.
Please pull back up on this side, on the version of the work.
On this side?
So you did discount back to year 3 and then you discount it back to the beginning?
Yes. It'll be the beginning of year 3.
Right.
Right.
So
Yeah.
it's
So it's 2 years.
So-
Yeah, back 2 more years. As a sum.
Yeah.
That was a sum. Got it. Exactly right. Exactly right. Sorry about that screw up. I'm really glad you caught it. It's your fault. Wrong. I can do that. It's easy to do. The tough thing is getting all your dollars at the same point. If they're doing a future dollar, I want them all at the same year. If they're doing a present dollar, I want them all now. Right?
You can see on this, I'm still getting.
200 at the beginning, is 200 right, at any discount rate right now, right? 200 is 200. So there's 200 going out at time 0, right? And then there's 200 coming in at time 5, which you discount for 5 years. So putting that 200 in working capital costs you about $100,000 in time value. Is that correct?
Yeah.
That's not a big thing. Okay. You don't have to be here, you said. That's good. Board. Good. Board it. Follow the slide. Could you get the negative 53 business?
That was still right.
I think a lot of this is practicing and relaxing when you get the quiz. You just relax and figure out where you're at. How much cash changes hands when? What's the discount rate? Does the discount rate change? You know? If I got an annuity, I'll use it. It saves me time.
How did you guys do the discount? Did you make that up or?
Up to 15% I made it up. I'm saying, I'm sort of, that's sort of a precursor to what we're going to do when you do cap in and weighted average capital. Your interest rate really is a couple points, 2 to 3% for the rent of your money. Real return, we say, this is theory, finance theory. And then expect inflation, whatever it is, around 2%. Now everybody keeps saying that even though we don't quite get that much, usually. But that's about what the, how the investment will be measured. So risk-free would be 2 to 3 plus 2. So 4 to 5% if there's no risk, I want, right? And then a risk premium, and you just judge that based on how risky the investment is. So I said, 10 to 11, make it full amount here. But we'll estimate that based on company's betas when we do weighted average cost of capital. Okay? And their beta is the variation of their returns, income, and dividends, the covariance of their returns with the market as a whole. Are they more or less risky? And we try to estimate. Okay, so with the 10 to 11, this is more risky than the market as a whole. Market as a whole might be 7, 6, 7, or 8.
I guess I'm just a little bit confused about like when and why you use the ordinary guarantee.
Well, it's going to save me time. I'm going to have to do years 2 through years 3. I'm sorry, years 3 through 10. I'd have to do 8 multiplications, right? What I can do instead is do 1 multiplication, and then discount it back to 10. So 2 multiplications.
Yeah, then you have to discount like 2 years.
But imagine
Because
if
you
it was
want
30 years.
to find the value of it right.
Now you got 30 multiplications to do versus 2. Does that make sense? It's just easier.
Yeah,
So the annuity starts year.
So an annuity is cash flows must be exactly the same every period. Well, they are, right? Cash flow every 8,000 every year.
You get the
Same.
discount
That's an
back in
annuity
2 years.
as long as the interest rate is.
So find the present value of that.
That's clear.
10%,
So
2 years.
we've got 15% interest rate, and we got 8,000 cash flow. You can treat that as an annuity. And it's annuity from year 3 to 10, the end of each of those years. That's an 8-year annuity. I would discount it, but when I do, it'll discount it to the beginning of year 3, which is 2 years from now. And then I've got to discount that as a lump sum, one time for the whole thing. Okay. So you use it when it's easier for you. That's the answer. It's always easier for you. Yeah, if you got very good years. Well, if I have 5 years. But if I got 20 years, 30 years on the deal, did you have a question?
Yeah.
Yeah.
So,
Yeah.
the annuity here, you got that.
177.
The sum of it,
Where'd you get it?
you got that, and you get the sum, that was for 80.
What do you
You
get?
did it for 2, and then you got annuity right here.
That's 80,000 for 8 years. It's worth 388. Is that right? Only 2 years, that'd be about, way too much. Sure, because it's the end of year 2. The beginning of year 3 is when your value gets figured out. So when you did your first calculation, you got the beginning of year 3, which is the end of year 2. Only discounted for 2 years. So take it times 1 over 1.5 squared, right? So you got way too little there, I think. And then you still got the 200 going out and coming back in, right? Right. Which is the same calculation, except now it's 10 years when you discount. Are we there? What do we get?
Negative 227,231.
And that's really a crummy deal. Okay.
Is that around?
For the whole thing?
Yeah, for the whole thing.
By the way, in your finance class, what you're going to do is you're going, and really we'll do that a little bit in when we do weighted average cost of capital here. We'll find out what the interest rate really is, what you really earn. Okay, so you could do a calculation for this to figure out exactly what the earnings were. For now, we're just doing net present values. A little easier.
And what you gonna do with that negative 200? You have to add in the 200,000 working capital back here, discounted by 10 years.
Yeah.
Should be a slight less than $50,000. Which that'll probably make up your difference then.
Yeah.
Made our income way too low, didn't it?
Yes.
Although it's interesting, because when you value the real businesses that you're looking at, they come up negative a
So
lot.
this is right then?
Yeah.
Yeah, people think, oh man, I can make money. And that's a lot of years, you don't get your cash until later years.
Is that negative in terms of what the market rate of return is?
Only in terms of your 50% return.
Okay.
Right?
Yeah.
Okay. So we can redo this with a different discount rate, and it might be a good deal. If you don't think it's as risky, the only thing that's gonna change your interest rate is risk. Because that, down here at the bottom where we have the true return, that's the same for everybody all the time. It's kind of a theoretical idea. The expected inflation is the same for everybody, right? Everybody's incurring the same inflation on everything, right? Okay, it's not really true because the only things I buy are bourbon, beer, and wine. And the inflation rate on that might be different than the market as a whole. That's a joke, come on. Okay, anyway, but different things go up at different inflation rates. Okay, so the risk premium is the only thing that would be different between investments. So we'll try that in a second, but let's calculate this thing. What do you have? Now, $200,000 going out, right guys? And that $200,000 is worth how much? Right now, at any discount rate, it's $200,000, right? There's no interest, there's no time goes by. So there's 200. At time 1, we have negative 300,000, right? We did this with the other one too. How are you going to do this one? Times 1 over 1.15. We already did that, didn't we? Raised to the first. How much was that anyway?
668.71.
60.
Okay, everybody got the idea? This is 0. All right. Year 2, we had negative 50,000. And then we're going to change this thing. 1 over 1.15 squared. You can just pick up the present value tables off, or the present value factors off the table, present value of the sum. How much was that?
37.806.
For some reason, I can't make 8s. All right, we got it. Okay, and then here's 3 through 10, end of the year, right? How much is it? Positive 80. So by the way, how much is this? It's 8 years at 80. How much is that? 640. So what's our net cash flow on this deal? and then there's the 200 coming back in, right? At year 10, we also have 200,000. That's our working capital coming back in. Everybody agree? So what's the deal? 200 out, 200 back in did nothing, right? Those two. And then we've got 350 lost and 640 gain. What's the difference between 640 and 350? 290. So over 10 years, we make 290,000. So you do have a profit on this. Does everybody agree? Okay. All right. So how would you value this one? This is an annuity, right? Present value. The payments are at the end, so it's an ordinary annuity. Look up the present value of an ordinary annuity factor for how many years? 8. And what interest rate? 15% was it? How much is that? What was that factor? What'd you get? It is 15%, 8 periods, right?
That was
732. Yeah. Okay, what's worth $4.49? $8 received $1 at the end of each year, right? For those 8 years. How much does that come up to?
358, 985.
Now, what's the problem with that? That's 2 years out, isn't it? We calculated the present value at the beginning of the 3rd year, right? So I need to discount that one for how long? 2 years. 1 over 1.15, go look up the factor, right? For 2 periods, same as that, right? Okay, so what's 358, 985 times 1 over 1.15 squared?
271,443.
And we get clobbered on this deal, don't we? Okay, so we're going to have this one, this one, this one, that one, right? And then what else do we need?
200,000.
Yeah, 200,000 discounted for how long? 10 years. 1 over 1.15 raised to the 10th. That's not worth very much, is it? 15% is a high interest rate. 10 years is a long time, right? How much is that worth?
$49,478.
1/4 as much. That sounds about right. 49. What was it?
438.
Does everybody agree that if I invested $49,438 at 15% compound interest, I would have 200,000? Just calculate, right? That's why that's what it's worth. I take the interest out. You'd earn 150,000 interest, right? You invest that long at 15%. They're 4 times your money. 15% for 10 years. Everybody good? Okay. All right. So what does the deal add up to? Horrible. Negative, isn't it? 200 plus 268,871 plus 37,807 plus 271,443 plus 49,438. What do you get? Negative, you said?
Yeah, I got negative 177,796.
Did everybody get that? Do those numbers work that way? All right.
So what does that number represent?
That's how much you would lose compared to making 15%. That's all it is. It's just horrible. If I want to earn 50, if I'm earning less than, if my net present value is less than 0, I'm not making a 15% discount rate. That's all I'm saying. Okay. So somebody'd have to pay me that much money to take this investment.
How would you figure out what exactly, like what rate that actually would be?
What you'd have to do is you put in all these cash flows and you would solve for what the interest rate is. So if you have a nice calculator, you can do that. We can use the formula to do that. And you'll do that in finance classes. Okay. So what we do is we put in all the cash flows when they are, and we put the timing of all the cash flows and the amount of the cash flows, and then it would force the present value to 0, right? And that's the interest rate that you earn. So let's try another one. Let's with this one. Let's say that what this was an investment with a bank. That's a weird one. But a bank is doing this with us, and we think that we should earn 8% on the deal. The risk level's real low. We're not quite guaranteed the cash flow at 8%. How much risk am I taking at 8% in our little example here? This would be risk-free, you guys. Risk-free is about 4 to 5%, right? So if this is only going to be 8% return, what do you think risk premium is? Yeah, this has got to be 3 to 4% in there somewhere. Okay? So it'd be a low-risk investment. Let's say I think this is a low-risk investment. It's backed by a big company or by a bank or something. I think that these cash flows are going to really happen. Okay? I think it's going to happen. Right? I got a deal with somebody. Maybe we got a customer that's going to buy this from us. It's Microsoft. And they're locking into a deal. Okay? So the risk is minimal. What would change? What would you do if it's 8% instead of 15%? It's really simple. Just change your factors. Calculate it at 8%. What happens to this deal at 8%? I bet it's a lot better. Right? So what things can you work on? Well, do I believe the risk level? You can work on what the cash flows are. Could I get some more cash in or cash, less cash out? What's the goal for this deal to work? So people do this all the time. You're negotiating how you're going to do things. What are sales prices going to be? What are the costs going to be? Right? And what's realistic? What's your level of activity going to be? So can you see where this gets really valuable?
So when you give us one of these problems, you're looking for like net cash flow we're going to make from the deal, and then the
Discount rate.
discount. Right?
That's all you really need. What are the pieces that we suggested we needed, you guys? What were those pieces we suggested we needed?
Periods.
Number of periods, interest rate, present value, which is what it's worth now, right? And future value. That number of periods from now, right? Same number of periods here and here. Everybody got it? Those are the three pieces if it's a lump sum. Or the four pieces. I'll give you three to solve for the fourth. That's the story. Okay, that's all we're going to do. And then the other piece you might have is a what? Annuity payment. And it can be what? Either at the beginning of the period or the end. What do we call it if it's the beginning? At the beginning. Due. Because it's due now. At the end? Ordinary. So here we go. I'd like to know this. This is 10%. This is $100,000. This is 200,000. All I'm saying is I'm investing $100,000 now. I'm going to have 200,000 at the end. I'm earning 10% interest, and I want to know how long it's going to take me to earn it. Could you do it? Do that. No, there's no way to do it. Real simple. Set yourself up a formula as though you were calculating either the present value or the future value and solve for the unknown. Okay? The unknown is your present value factor or future value factor, whichever one you want to use. And then you know the interest rate, so you can look at the table and find the number of periods. Okay, so we'll do this. That's fine. Between 6 and 7 somewhere. And we could interpolate, it's called, by taking the difference and figuring out what portion of it is. But what we really do is we use Excel or we use a calculator, and it will tell us. What you do in a calculator is you put in the interest rate, the present value, the future value, and have to solve for the number of periods. Or in Excel. Anybody got a calculator that's fancy enough for that? Probably do. Solve for the number of periods. Boom, it'll come out. That one will do it.
I don't know how to use those, like the file instructions on these things.
Go online and read it. They're all a little different. It's in the calculators. Go online and read it or look it up in your little book. It came with it. So,
There's like the programs.
you don't need that. It's in the financial functions.
Yeah, that's what.
Yeah.
I was thinking how to use it.
You want to learn that, you can wait for my
Yeah, I probably don't.
So what do we get? Somewhere between what and what?
7 and 8.
Which one is it closer? Here's 7 and 8.
It's 7.
Which one is it closer to?
7.
7. Okay, so, and we can do what's called interpolate. What you do is you look at, you write down both of them, right? Write down your factor and both of those other factors. Take the difference between your factor and those factors and get the percentage that you are from one to the other. And then take it times 1% because it's somewhere between 7 and 8. You find out about what it is. So it's close to 8, is it? You said it's close to 7? Close to 7. Okay. So on a quiz or test, if you told me it's in between those two, that'd be good, or it's close to 1.
Can't you just take the ln of both sides for the equation?
Can't you do what?
Take the ln natural.
Yes. Yeah. Absolutely. Got it. Simple. Yeah, I do that. Yeah. Okay, so what would we do here? How'd you set it up? I've got, you can either put the present value over here and the future value over here, or vice versa, I don't care. This is the way you could do it to just think about it, you guys. Okay, that times, the present value times 1 plus the interest rate raised to the number of periods is the future value, that number of periods from now, right? And you know you have a present value of 100,000. And you know you have a future value of 200,000. So can you find out what this factor is that is 1 plus the interest rate? And you know the interest rate's 10%, right? So you've got 1 plus 10%, so 1.10, I guess we'll write it like that, raised to some number of periods equals that 200. So what's this factor right here? Obviously, in my simple little lamp example, it's 2.0, isn't it? So what you could do is you could go to the table for the future value of a sum. So go to your future value of a sum table, right? Go to the, find the 10% interest rate, and go down until you find 2.0, right? And where are you when you find that? Between 7 and 8%, okay? And you're there.
How do you do 2.0?
It's 100 times 2, that's 2.
I divided 100 into 2.
Oh, that's how you did it.
Yeah. You can do it the other way around. Let's do it the other way around, and what do you have? You put the 200 over here, the future value, and put the 100 over here, and now you got 0.5, don't you?
Yeah.
Go to the present value of the sum table and go down until you find 0.5, right? And where is that? In the 10% column till you find 0.5. Between 7 and 8, same thing. Are we good? This is easy, isn't it? Once you see it, okay? And they'll ask you this stuff. I'm going to ask you on the quizzes. I'll give you some free points. Okay, how about if we change this a little bit? Let's change it a little bit, and let's say instead we know this. Let's say this is 10 periods. This I don't know. This is $100,000. And this is $200,000. What's going to change? It's the same problem, isn't it? Except now what do you know? Yeah, you got the number of periods. So you go down to 10 periods. So it's going to be the same factor. 2.0 if you use it for, if you're doing it set up as a future value like this, or 0.5. Everybody staying with me on this? Or 0.5 if you set it up as a present value. Go to the appropriate table. You might do it both ways, right? Save yourself, right? And what do we find for the interest rate? Around 8%. Okay. Close to 8. Did everybody find that on the table? We could set it up exactly the same, right? I got the 100 and the 200. We could set it up right like this, only this time I don't know the interest rate, but I do know the number of periods. This is 10, right? So I go to 10 periods and I try to solve for the interest rate. I'm looking for it. But I've still got 2. So on the future value of sum table, right? I'm looking for that factor of 2. I go to 10 periods and I go across until I find the interest rate. And it's about 8, I guess. That's all right?
Is there a reason why something's not in here?
No, it annoys me. Maybe they had a misprint when they did the book. I don't know. It's weird. They left one of them out.
I would think that it might be around 7.
Oh, it was somewhere between 6 and 8.
Between 6 and 8.
Yeah.
Yeah. So maybe closer to 7. Can you do this, guys? If I left out the present value, the future value, you could certainly calculate that, couldn't you? By the way, can you get interest rates and number of periods if it's an annuity? would you not know if I had the annuity? What would I probably leave out? Let's say I'm talking about interest rate, for the periods. When I read a problem that's an essay form, you know, sentences, a bunch of sentences, short essay, I guess. Interest rate, number of periods, present value, future value, that number of periods from now, and I might also have annuity payment. If the thing says they want to know the annuity payment, right? They'd like to know what the payment needs to be, right? What should my payment be? My interest rate is 10%. My number of periods is 20. My present value is $100,000. Maybe they won't give you the future value. Or they'll give you the future value and not give you the present value. If they give you the present value, that's how much they're going to invest for this cash flow stream, right? If they give you the future value, that's what the cash flow stream has to grow to. Does that make sense? And they might say, how much would you invest now? Well, that's the present value. How much I'd give them now? Or how much would you buy the asset for? That's how much I'd give them now, right? Or what am I going to have later if I make these investments? Does that work? Okay, so anyway, what I want to know is the annuity payment. You got to know one other thing. What else must they be asking you? I gave you this, I gave you this, I gave you this. That's not going to matter. I'm not calculating a future value. And I want to know what the payment is. What else do you need to know about the payment before you can calculate it? Beginning or end. Yeah. So let's say the payment is in the beginning of the year. Solve that. About how you set it up is solved. I think they developed a lot of them. They put everything back down. I found it out of calculator without a computer. Oh my God, I'm pretty sure you can avoid that. But it makes it more complex. So everybody got an answer? How do we want to set this up? I don't care if you use the author's approach or mine, of course. Is this an annuity due or ordinary? Annuity due. So you got to know that, right? Otherwise you get the wrong factor. I'm looking for this, right? Okay. I gave you a present value. If I gave you a future value, you don't care. You use the future if I gave you that. So this is a present value. It's 100,000. Okay. And this is going to be a what? Seeing as I know the present value, I want the payment. It's the present value of an annuity due. I'm gonna look up that factor, right? What's my interest rate? 10%, wasn't it? What's my number of periods? 20. So what's the payment gonna have to be? What kind of a payment? That's this factor I'm looking for here. What kind of a payment I'm gonna have to have, right? So when I take it times that factor, it's gonna be 100,000. That's all it is. So look up the factor. Look at the present value of an annuity due on the table. 10%, 20 periods. What is that factor? Anybody?
Not the 43.6, 492.
What's worth $9.36? $20 received at the end of each period for 20 periods, all discounted at 10% interest. So how much are you gonna have to deposit? Oh, seven, 6, 7, 8, 10,
6, 7, 8, yeah.
6, 7, 8. Okay? So if I deposit, how much money am I taking out, by the way? How much money do I get? If I invest 100,000 in this, this present value is 100, I invest 100,000 in this, how much do I get to take out? 10,678 times what? 20 payments. Don't lose track of what we're doing here, guys. What's 20 times 10,678? Then it's not magic.
213, 516.
2,
13, 562, or 563.
yeah, okay. So how much is the interest I'd earn if I asked you a question like that? To make sure you know what you're doing. I'd earn $113,563, and we'd say that is what? 10% interest. Right, guys? Yeah, it's the difference between what I invest, which is 100, right? And what I get back, which is $213,563. So if I buy this for $100,000, right, I'll get payments of $10,678, and that'll total $213,563, and I will have earned $113,563 of interest. How about if I sell it to somebody for $100,000? And I pay them back $213,563. I will have paid interest of $113,563. Depends on which side of the deal you're on, right? So if you invest in it, you'll earn 10%. If you sell it, you'll have paid 10%. Even, you know, it's fine. Right? Looks so easy. Let's change. The payments are at the end of the period. I'll do stuff like this too. I'll give you a problem maybe somewhere on a quiz test or final where I'll give you, you know, the same problem, and I'll just say, oh, one's at the beginning, one's at the end. What would change to your payment? How much would your payment change to? Can you do that? I think the answer to that's going to be absolutely. What's the only thing that's going to change?
Your factor.
Your factor's going to change by what?
10%.
If it's an ordinary annuity, you're making the payments at the end, so is there going to be more or less interest? More, huh? So it's going to be worth less. Is that right? So you could take that factor times 1.10 and get the other factor, right? You can do it, or you can just look it up. Okay. So it's going to be set it up exactly the same way. Now this is the end, so this is an ordinary annuity, right? So I want to know what my ordinary annuity payment is. That's what I'm looking for. Go ahead and do it. You know the present value at times 0 is 100,000. I know that this is a present value of an ordinary annuity. N equals 20. I equals 10%. So whatever the interest rate is, whatever the number of periods is, you'll find that factor.
So we never had to figure out the future value.
No, but you could if you wanted to. Right? You have a number of periods in the interest rate. Good if you wanted to. Or if I gave you the future value, just use the future value, don't bother with getting the present value, right? They tell you how much you want to have in the future and you're investing in it, you got a future value. They tell you what you're going to pay now, it's the present value. So now what would you have? Well, now I have a future value of an annuity calculated. Try to pick up that factor. A lot different, right? Obviously, the present value is worth less, the future value is
You're
worth
gonna
more.
give us the future value, annuities too, since it's not that low.
Of course. How do you convert the tables? It's easy.
All you have to do is times 1.1.
Yeah,
whatever
yeah.
percent.
You got it. You can convert the table really. I used to teach with a guy that would give students one table, a present value, future value table, no annuity tables, and expect it to be. I think it's too much of a game. But could you create the table off of one table? Yeah. The future value is the reciprocal of the present value on the sum, right? Just take the reciprocal of every single one of them. Do you guys agree that they're reciprocal? Let me show you this. One plus the interest rate, right? Raised to the number of periods. Isn't that a future value factor? 1 over 1 plus the interest rate, raised to the number of periods. Isn't that a present value factor? See a relationship between those two? They're just a reciprocal of each other. So if you knew the present value factor for a number of periods and an interest rate, how could you convert it into the future value factor? Divide it into 1. What do you do the future value? Divide it into 1. You got the other one. What is doing an annuity? Add up year 1 plus year 2 plus year 3, whatever number you need, right? It would work. So could you convert from one to the other? Sure. Really easy. Maybe that's why they leave one out, is to make sure that you really understand what those tables are doing. What I like about the tables too is you can look at those tables and you can, it's not intuitive, is it? Take a look at the 15% column and compare it to the 5% column. Or you look at the present value. What's a dollar 20 years from now discounted at 5% rate right now? 20 years from now, 5%, what's a dollar worth right now? 37 cents? Do it at 15%. 6 cents. Is that intuitive? I don't think so. But it's true, right? It's real. That compounding really makes a huge difference. Do it the other way around. Look at the future value of the sum table and do the same thing. What does a dollar grow to in 20 years at 5%? Yeah, you'll have 2.6 times as much money as you invested, right? How about 15%? 16. Yeah. Of course, what do you have if you are going to earn 15 instead of 5? More what? Risk. But you know what? When you have a diversified investment out of the stock market, you're on average 12. What does 12 look like compared to 5? People are invested in low risk stuff are crazy. 9.64. 9.64 instead of 2.6. Keep the same. Get the stock. When I retire, I'm going to get stock. I got a young wife. She's going to live 20 years after I'm gone, probably. She's 10 years younger than me. I'm a guy. She's a healthy female. What do you think? She's probably going to live 20 years when I'm gone. Am I taking the money out of the stock market? And have her earn inflation? Right? Live on almost nothing? No. Get your money invested at a reasonable risk level. Reasonable. I'm not saying buy one type of stock, invest all your money in it, like people at Enron did that work there, right? And then when the company goes bankrupt, that's nothing. And no. That's not. What do I mean by diversified? A bunch of different stocks. My investments are across the entire right? It never comes on. It goes down, I get hurt. It goes up, I win. Over time, it tends to go up, right? What if I put my money into a savings account instead? For sure, I would not earn inflation. I get poorer every year, right? Because of inflation. So, yeah, there'd be no risk, but I get poorer. I think that's horrible. I don't like that. What number did you guys get?
11,746.
11 11 point,
Oh, no, not the, I'm talking about the total.
oh, this is 11.
Well,
Yeah.
So you have to deposit more if you're making the deposits? Or I'm sorry, not deposits. Yeah, no. If I invest 100, I have to pay them back. I have to pay them back more, or they earn more? Really? How come? Why is it more? Do you get that intuitively? Why does it have to be more?
Because it's at the end of the period.
Yeah, it's the end of the period, there's one more period interest on all of them. So what's our factor? What was that factor you got?
8.51356.
Tell me the relationship between these two. Let's look at this one.
That one, 9.36 is 10% more, 10% right here.
They're both 10.
So it's 2% more than the 8.5.
Oh, it's 10% more, yeah, because there's one more period's interest, I got you, sorry. Okay, so if you took the 8.51356 times 1.1, would you get 9.36492? Yeah, and of course the reverse is true. 9.36492 divided by 1.1, you get down to 8.51, big deal, right? So what's the hard thing on all of this? Do you know how much can cash changes hands each period? Get it down, right? Period by period by period. Do you know the discount rate? Fine. Do you know the number of periods? Fine. And then either know the future value or the present value, whatever they give you. Only one thing's going to be missing. Sometimes it bothers people if it's an annuity payment and they don't give you both the present value and the future value. Could I give you a problem like that? Let's do one more real quick. We'll get out of here on time or something. Let's do one more. How about if you had this? I want to know that. And I'd say it in words, right? And I've got an ordinary annuity payment. And I'd say just payment at the end of the year. Give me both of those. That's 12%. 12%. This is going to be terrible for me. I'm going to try and read my writing after the fact. So we're talking about 150,000, right? 15 times 10. What's the 150,000 worth? Really, it's two different deals, isn't it? Calculating the present value and future value. Not cool. You must like the warm weather.
I hate that in the summer. It's like unbearable outside, but it's also unbearably cold inside most places too. So
We air
it's like,
conditioned too much.
yeah, so I'll be carrying a jacket everywhere, and it's like it's 90 degrees.
People are a lot tougher for Christmas things air conditioned. We've got all these windows and they open, it can be hot in here. school, you can do the whole way. Spring was on, fall was on, summer was on. 100 degrees sometimes. But it's dry. But still, right? Brain quit working. Okay, you guys got it? Yes?
Yeah.
What'd you do?
Well, for the present value, I did 10,000 times 1 minus 1 over 1.12 to the 15th, all divided by 1.12. And I got 68,108.64. For the present value.
For the value of it.
For the present value. I think that's right.
It's an ordinary annuity payment.
Yeah.
Only 150.
Yeah.
You took what times it? You took the ordinary annuity payment and made it a figure on it.
Yeah, I didn't use the payment.
Okay,
The
got it.
thing was-
Use the formula.
Yeah, that's equal to the same.
Okay, okay, use the formula.
810.
Okay, very good. All right, so we've got, so we're gonna do a, you doing the present value or future value? Present value. So what you'd want is a present value factor, or you could use the formula, right? Right away. All right, and it's of an ordinary annuity, right? And we look it up for, in, or put in your calculator, or in your formula calculator. In is 15, I is 12%, right? Okay, what was that factor?
6.81086.
Yeah, okay. And so it's worth 68,000?
108.
108.60, I guess? Okay, and then what'd you do for your future value?
Put back at 37.27971.
Okay, so you could use the 10,000, right? And now that's an ordinary annuity payment still. And I want to know a future value 15 periods from now. Okay, it's the same interest rate, right? The same number of periods. What would that factor be for compounding? What do we got?
37.27971.
Okay, so how much is that?
372797.
372797. Get my decimal in the right place. Where did it go? 372? No, 797?
Yeah.
Yeah. Okay. And then some pennies probably. Nothing to it. They're different. What happened in those two investments? If I'm the investor, what am I doing? What am I doing on the first one? If I'm the investor,
Receiving 10,000.
I'm receiving 10,000 each period for 15 periods, right? And I made it ordinary, so it's the end of the period for 15 periods. So I'm receiving 150, and what did I invest? 68,109. I'd be willing to pay for it. Okay. If I'm the investor in the other one, what will the deal be?
You're putting in 10,000.
I'm putting in 10,000 every period, right? So I'm putting in 150,000, 10,000 at the end of each period for 15 periods. And how much will it grow to by the end? 372,797.
And of course, we can always do the 68,000 times the future value single.
Yeah. Could you turn this into this? What's 68 times 1 over 1.12 raised to 15? Did it work?
You just have to do 1 plus.
Yeah. I think you do that.
Oh, yeah, 1 plus.
1 plus.
I said wrong. Yeah. Oh, I'm doing future, not 1 over. Yeah, 1 plus the interest rate. Raising the interest rate. Yeah, and how would you discount it? Take the 372,797 times what? 1 over 1.15 raised the number of periods, and you'll get back down to the 68. So, would it have made sense necessarily to use the annuity for both of these? You wouldn't have to. You could calculate either one of them, the present value or the future value, and then go directly to it as a lump sum. It's okay, dude. Doesn't make any difference. Once you practice this a bunch of times, it gets really easy. What's going to be hard? Figuring out when you get the cash, or when you pay out the cash. Am I getting it or paying it out? Figuring out the number of periods is going to be hard, right? And figuring out the discount rate is going to be hard. That's true in real life. That's what calculating is a joke, right? Now, do a bunch of them. I have students that tell me they work every single problem at the end of the chapter, which is works. Anybody done that yet? You work them all? Anybody work them all yet? Work them all. You're going to be really fast at it. Boom, 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 boom. And I don't care if you use a calculator or, if you use a paper. Doesn't make a difference. Make sure you're using the calculator so I do. Right? And also, when you get an answer, make sure it looks like it makes sense. Present values are not more than the investment. Or present value is not more than what you're going to receive in the future. Future value is not less than you invest. Come on, please get that. That's fine. See ya. Keep working.